With a changing market, investing success requires a clear strategy and a track record of performance. If you're serious about building a property portfolio, you need to speak with Lachlan Vidler and his team at Atlas Property Group. As a national finalist for 2022 Buyer's Agent of the Year, Lachlan and his team are ready to build and scale your portfolio in any market. Whether it's financial freedom or a more secure future, Atlas Property Group is here to guide and support your personalised journey. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, Phil Tarrant. How you going? Host of Smart Property Investment Show. I was just only looking at the feed of this on the Apple iTunes player, and I think that's where a lot of you folk choose to listen to this particular podcast. And please keep those reviews coming. I do like them. We like them. It's just not myself here behind the microphone. It's a great team of property practitioners that work across our AV broadcast team who do all the heavy making me sound good. If you keep those reviews coming in that app, 5 stars, if that's what we think we're due, and some comments and stuff, that's really cool. But we're looking down the eyeball of over 1,000 soon. So 1,000 podcasts. It just got me sitting there thinking, wow, that's a lot of talking. And they reckon you've got to do something for multiple number of hours before you get any good at it. And I do get a lot of harsh criticism still on this show about my inadequacies as a podcast. And one of those critics is Paul Glossop. He's from Pure Property Investment. He's a CEO. He likes to give me a hard time about it. He's joining me back in the show. Why I let him on, I don't know. But I'm told by other people that he seems to know what he's talking about. Paul, how you going?
Very well, Phil. One of your many inadequacies is your inability to say the word inadequacy from time to time.
Inadequacy. I can say inadequacy. I do struggle with words. We've spoken about this before. The words I struggle with are trajectory. Trajectory. I struggle with that word. What else do I struggle with?
I'm sure we'll find a few.
Yeah, we do.
Throughout the state of this podcast.
But this is the beauty of podcasting, Paul. It's raw, it's uncut, it's unpolished, bit rough around the edges. I think I'm pretty much that's how a lot of people would describe me. But it's what we do. Hey, how you been? You good?
Yeah, very good, mate. Busy on a lot of fronts. A bit less business as usual, a bit more business as unusual for the time being, which is good because I think we're in that movement of markets at the moment, right across the board, which is always an interesting time as a property investor myself, as well as an investment property strategist and buyer's agent leading a team of those people, is that these times actually create some fun opportunities for us to really dive into new markets or markets we potentially were working in a number of years ago and now finding some opportunities back in.
Change is good. Don't be scared of Mr. Change, Mr. or Mrs. Change, whatever your version of change is. Change is where opportunities sit. Sometimes you've got to dig around and maybe stress test your thoughts or position against stuff, but change. I was only sitting there thinking a bit earlier today, and I know you're a big student of Australian politics. You're a bleeding heart Labor man, and the great Gough Whitlam, where he spoke about "It's time," one of the great campaign slogans of this last century. It's time for change. It's time is good. Is it time, Paul? Is it time to get back into the Sydney and Melbourne property markets as property investors? This is the big question.
It is a big question. It is a big question. I don't know. I think you're probably in a very similar scenario. And I know a few of the investors who you speak to on a regular basis are probably no doubt considering similar times for change at the moment. And it's not necessarily, I guess, the reasons why we look for change in markets is not necessarily the things that you think might be obvious, where it's, is there value or is some random, let's say Brisbane as an example, the Olympics is announced. Is that a reason to go into a market? Well, the reality is we're investing in that market a long, long time before that was announced. Was it time to invest in Sydney at the start of the Royal Commission into the banking sector? Well, that's probably the wrong time to invest if you're a doomsdayer. But as history will show, there was a lot of opportunity, and similar in Melbourne in that time, and Hobart back in 2014, 15, 16, when people were looking at it as, hey, that's just the sleepy cousin of every other major city in Australia. Is it time? I think absolutely. It needs to start to become back on the radar as far as the major metro markets for a variety of reasons. Absolutely sitting there in the higher and lower ends of this market right now.
And a lot of property punters have been sort of kicking around in the background. I know a lot of buyers agents, and I know you do a lot of work with Pippa, the Property Investment Professional Australia, which is a really good cohort of good operators that work inside of the property profession. There's many sort of buyers agents in there. We know them all. And they're saying a lot of the same things around, Sydney particular and Melbourne to some degree was not on the nose for buying property, but for property investors looking to deploy their money in the most effective place to get capital uplift or yield, really hasn't been the Sydney market over the last, call it 4 or 5 years. There's been times when Sydney is red hot for getting in there, where both myself and you started our property journey at a similar type of time, within probably a year of each other, bought a lot of stuff in Sydney back when buying in Sydney was the right time. And we were pretty active in the western suburbs of Sydney, and that was a good market for us at that time. We probably had a few less bucks then, and that was really all that was accessible, available to us as investment properties, and it fit our particular profile then and our strategic direction, where a lot of Australians were investing in property, by the way. And you think back to those price points. I remember walking away from auctions a decade ago because it went $5,000 over $290,000, for a 3-bedroom house in the western suburbs.
And you'd be shaking your head thinking they've overpaid by
They've overpaid by 10 grand. What an idiot. Those same properties now are sort of $700,000-$800,000 and some. So the right time, right place, right markets, right point in your investing journey. So when we talk about, is it time to get back into Sydney or is it time to get back into Melbourne, there's going to be different ways in which Australian investors will capitalise on those different market segments. Personally, I'm gearing up to get stuck into the Sydney market again. I won't be buying the same properties I was buying 10 years ago.
Yeah, and that is the key part to, I think, this whole conversation today, mate, is that, we talk about, is it time to possibly get back into the Sydney market? Well, again, I don't want to be sounding too flippant with the "it depends" commentary, but your situation as the avatar, Phil, is probably the classic example, because if we're sort of taking the similar person who's listening to this and says, well, I've bought a home, let's say it was a decade ago, I've had really good growth, I've taken some of that equity out, I've reinvested, let's say hypothetically, into the Brisbane market, because I personally, within Pure Property Investment, we probably have quite a number of hundreds, if not thousands of clients of ours who have got some exposure in the Brisbane market over the last 4, 5, 6 years. And the reality is they've probably got in the vicinity of, in some cases, 30, 40%, in other cases, 100% growth in that time. And you're sort of sitting there with that portfolio now saying, okay, well, I've got my home in Sydney as an example, or let's say in Melbourne, I've got an investment that's seen really good growth. The cash flow is still fine and it's not really causing me any issues. Am I now in a position where I see that same level of growth is going to come over the next 3 to 5 years? Or do I redeploy that same cash and put it into a market which maybe has been a little bit less, I guess, opportunistic as far as growth and maybe is improving radically as far as cash flow is concerned? One thing I probably would note is that the Sydney market and the Melbourne markets in particular have never been, for the length of the 30 or 40-year data, if you look at historical residential data, they've never been the cash flow markets. They're not the cash cow markets compared to other areas. Now, there's definitely been times in the cycles where they've given decent cash flow compared to the current interest rate of that day, but they're never going to be the darlings of the cash flow markets. And it's for obvious reasons, is that ultimately they just don't trade because of the speculation that typically sits with those higher markets of those 7, 8, 9, 10% yielding markets. They have certainly been consistent as far as Sydney and Melbourne's concerned with capital growth, but over the last 3 or 4 years, most people would probably be surprised. But if you looked under the hood of the major markets of the 7 major cities in Australia over the last 4 years, let's say since 2018, Sydney and Melbourne actually rank towards the bottom of the pack. And that's comparing it to Brisbane, comparing it to Hobart, comparing it to Canberra, comparing it to Adelaide, comparing it now even to Perth as it's starting to creep up, and even Darwin over the last probably 18 months. They're not necessarily been those markets that have performed well, but we're seeing now a lot of data coming in, a lot more interstate and overseas migration now starting to circle back to Sydney and to Melbourne, which has really historically been one of the big pressures of where the drivers of capital growth and also demand for rents are coming in. Now we're seeing sub 1% vacancy rates as well as prices that are starting to become more reminiscent of 2019. Is this a good time to buy in the Sydney market? Well, I personally just bought a property over the weekend in Sydney in my own portfolio as an example.
And this is the point, the sooner you can get going in property, the better off you are, because you get to experience different market cycles. Now, we sort of speak about, we started off investing in similar time, similar places, within streets of each other by memory. Western suburbs of Sydney, and I still hold a lot of those. I still hold all of those assets, to be honest with you. And you see a lot of them inside the Smart Property Investment portfolio. There must be, I don't know, 6 or 7 properties maybe in and around the Penrith, Blacktown local area governments, which I think is now merged into one. I think you used to have a St Mary's Council, which got swallowed up.
Yeah.
So there's a lot of assets in and around there. I think you still own some of those properties still that you bought out there then. Now, that's a decade ago. So within that decade, we've seen significant capital growth. We've extracted that equity. We've deployed it into other markets in different capital cities and regional locations for different reasons. And when I think about the Smart Property Investment portfolio, we're going to do a big update soon on it, but that portfolio doesn't owe us any money. You go and check this thing out on smartpropertyinvestment.com. We've been talking about it for years now, but the original money that we used to kickstart that property portfolio off, which was about $200,000, got us going. We pulled that money back out probably, 5 years after we started it. So we don't actually have any original investment into that portfolio, and that portfolio is now worth $9 million, right? Probably at about 60% LVR as it sits right now. It's probably up and down a bit, left and right, whatever. But 10 years on, the type of properties and where we are on an investment journey, particularly with Smart Property Investment, is we'll be buying different assets. We don't need to operate. We don't have to, and I don't want to operate in those type of asset classes that we were investing in. However, those asset classes that we did invest in at that point in time has been a huge enabler for us in order to go out and build a portfolio. And you must see this same story time and time again, right? This is the whole concept of being in the market rather than observing the market and not participating in the market is where you get a choice to work out how you can capitalize on it moving forward. You see people go through these decade cycles in the clients that you work with, Paul, and the type of assets they're buying. Still might be buying in the same capital city location, but very different price points, no doubt.
Absolutely, mate. And I think it's a pretty astute observation is that, your example there of having exposure to a particular market for well over a decade and sort of looking at what that's enabled you to do. You mentioned that you started with a $200,000 capital injection, which led to an initial starting portfolio back then was probably a couple of $1 million across a number of assets, which, granted, back then there was different lending policies. 95% LVR was a bit more common,
a lot easier.
All those things. But it still didn't, I guess one thing that didn't change was that you were the person who took the decisive, opportunity to say, if it's going to happen, I need to be responsible for making it happen. Now, you can talk, like you said, you can talk about it from the sidelines to no degree of stopping in the sense that you're going to say, okay, well, look, in that market, I probably shouldn't have bought that. I could have bought that, but the shoulda, coulda, wouldas couldn't happen over and over and over. But one thing that you have done, which I've found personally, to your point of working with clients now who have bought well over a decade ago and bought multiple properties in a particular market, i.e. Sydney or Melbourne at that time, then recycling that equity out into another market and so on and so forth. One thing that I've seen very consistently now, which I think you're going through, Phil, is that you have to go a little bit bigger to then right size. So one thing you eventually know that you have to get the exposure, which takes risk and it takes a bit more, pushing yourself out of your comfort zone to get the exposure and then being patient for a prolonged period of time to then say, okay, do I need this many assets? Do I need these types of assets? Or do I now take that profit, recycle that money back into potentially less assets that are going to do more heavy lifting and provide me with a better outcome that I need? And what I find over and over doing this modeling with clients now is that we need to go a bit bigger to then right size to a bit smaller. And that typically means that the right sizing position for someone who's going to hold a really good quality portfolio with decent cash flow, a good LVR position, which is going to see them in a really strong retirement position, is typically that 4 to 6 assets, really good quality assets. But you can't buy 4 to 6 good quality assets from day one, unfortunately, for the vast majority of us. And if you sat tight, Phil, and you just put that $200,000 into one asset, would you have got to where you are right now? I personally highly doubt it.
No, and you need to play it this way. And it's not like you can go out and buy a perfect portfolio at the get-go. And those people that do that typically don't do it because they never get around to it, or there's some reason why they can't do it, or all these people, or they're the 80-odd% of all property investors own between 1 or 2 properties because they thought they did it and they're on the way to do that. And then they work out pretty quickly they've bought something that doesn't suit their portfolio and it's bleeding them when it comes to negative cash flow, and it's not going up in value, so they can't refinance, all this sort of stuff. So you've got to play the game, and I've been and continue to be a huge proponent of strategic patience. You've got to be patient with this stuff. You can't hurry love, Paul. You know that. It's
absolutely.
It's in the song. It's you got to wait around. However, if you do wait around and you start early enough, then you can sit back and go, you know what? Maybe it's time to downsize in terms of the number of properties in a portfolio, and redeploy the money in markets which you're going to get a different outcome. And largely you want capital growth and yield. But as you start thinking about moving towards a zero debt position, so 100% owned assets, which provide you with cash flow, which is what for many people they invest in property for this dream of retirement is. You've got to start making those calls, but you need to be dialed in. You need to be in tune with the market and the opportunities and where you should be buying and where you are in your personal situation. I want to break that down a little bit more. Let's go to a quick break. Stay with us, everyone. Back in a moment.
Throughout 2022, we've already seen a huge ebb and flow in the Australian housing market. Property prices increased earlier in the year, but the rate hikes have slowed down price growth over the last few months. Even so, we've seen more new listings hitting the market than we've experienced in recent years. Plus, with many property owners having accrued a significant increase in equity, the market is hot for investors looking to snap up another property that may have reduced in price. To help you find these properties, the team at Pure Property Investment have done all the legwork to identify the top 30 suburbs that have not only shown growth throughout this year, but are also poised for strong capital growth over the next few years. Grab your free top 30 guide to property investment guide today at www.purepropertyinvestment.com.
Welcome back. It's Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop. He's the CEO over at Pure Property Investment. You haven't mentioned your book yet, Paul, by the way.
But I was just about to bring it out. It's funny because
you like that ESP?
ESP, nice one. I actually, it's funny because as we're going through this in my mind, I was like, you know what? I spent about 3 months.
You got to update your book. You're missing this. You need a new chapter.
Well, I'll give a flash that it's to this exact point, is that the version 2 of the Surface Guide to Property Investing, which people can grab via our website at purepropertyinvestment.com. The next version is going to be a Surface Guide to Property Investing, and the actual tagline is Finding the Exit. Which has obviously got a little bit of a double meaning of if you're a surfer, you probably understand what that means. But if you're a property investor, you obviously are going to understand what the exit actually is going to mean. And the exit will be a little bit different depending on where you're going to be coming and going from. But this is what we're truly talking about. Is it not necessarily saying that buying in Sydney or Melbourne in this current environment is exiting, but it's starting early enough to be patient, not hurrying love, as you've said, Phil. And then getting the point of saying, you know what, you've got the equity, you've got the ability. And we know that having too many assets not only sometimes causes a logistical nightmare and a headache, but it also sometimes is unnecessary. And then figuring out how to retire debt successfully, reinvest that debt into assets which you're going to hold long term. And when I say long term, you're talking a couple of decades minimum, possibly even legacy purchases, and then going through that process. But yeah, mate, that's the new version of the book as an FYI.
There you go. Well, I didn't mean
but it's
to
not
do
there yet.
that.
It's not there yet. People need to be patient on that front.
Yeah. Hey, so when's the new book out, Paul? What do we know?
Oh, mate, it'd be patience.
Have you written it yet, or you just thought about it?
No, we're working on it. And I know from my experience,
got a whole team working on it.
Working on it last time. It was a couple of years in the making.
Well, it's a good thing, right? And the idea being that as you go through an investment journey, things change, right? The strategy largely should stay consistent, and that is, buying good properties for the purpose of, whatever you want to do. But how you do it might change. When I look at the Sydney market now, and we're talking about, is it time to get back into Sydney or Melbourne market, and where you'll be doing that? Give me some sense for areas that you like and why, or what sort of particular asset classes are good.
I'll give you an example. I mentioned that I bought a property recently, only literally last weekend. And this is probably an example for investors who maybe have a mature portfolio and it's exposed to a number of markets, and they're sort of thinking, well, how do I downsize it? Maybe grab assets which are going to have a relatively low LVR. I personally spend a lot of my property investment time for my own portfolio on assets which I know I can develop in the future, that are also ideally underutilized from a land size perspective, or potentially aren't necessarily marketed the best. So for my example, it's typically a higher price point, north of $1 million, sometimes north of $2 or $3 million, depending on the asset type. So if I'm looking at someone who's got exposure and is happy to take on a $1 or $2 million debt and probably take on a 3-4% yield on that property, there's a number of markets that are probably in areas I'll give some examples within the Sutherland Shire. There's quite a number of areas in there that are probably were trading $2.5, $3 million, now down more like that $1.5 to $2 million. So you've seen a genuine 15, 18% reduction in value. Yeah, genuinely. So I'll give an example. Here's a classic example. I know we spoke about last time we caught up, Phil, about under market value and what that actually means. Well, here's an example. I bought this property I bought it at auction. I was the only other person there was an owner occupier. I knew they didn't have any more money than a particular threshold. There's no one else. We were going to potentially even buy it pre-auction because at that stage you're going to pull the pin. Fully renovated house, 600 odd square meters, R3 zoning, big frontage of over 18 meters, which led to the ability for a real simple duplex to be constructed, and quite an attractive duplex. You know, you had a great land asset ratio at that time. The actual land value of this property, the Governor General's land value was over $1.3 million. In that same street, 4 houses up, there was a house identical, clad home, fully renovated, same zoning, same land size, same orientation, that sold in April of this year for $1.983 million, which again had all the same hallmarks, could live it out, rented for a bit over $1,000 a week, same as this property. Long story short, I secured this property for $1.63 million at auction, and majority of that value, as I've just allocated, is in the land value. So technically, about close to 80% of the actual value of this purchase was in the land. And I'm always a big fan of buying with a 60% minimum value of your purchase above that land value. Now, I know that all sounds a bit technical, but there's two things. One of which is A, buying in a market that's probably finding its floor, B, buying with some value add upside. And literally next door to this property that I've bought, there's a brand new duplex that's going to market, and that's going to be selling for around about $1.9 to $2 million, literally next door. And the construction of that duplex, having constructed a number of duplexes myself in that area or in that high-end area, you're talking about $1.4 million construction. So simple math will tell you that you buy for let's say 1.7 after all said and done. You build for 1.4, you're in for about 3.1 million. You've got two assets that are worth about $3.8 million. So simple math will tell you that you can't go backwards at a rate of knots if you're buying well at those early stages.
So it sounds like this is a double utility of like a bit of a land bank play, right? So you put investors in there for a period of time, and however long that is, who knows? But if there's duplex being built along the street currently now, and there is a precedent for that, it means that in time you can knock it down and put another duplex on there.
Absolutely. But you're kind of buying, like you said, mate, with a bit more of a multifaceted utility, which I'm always a big fan of, regardless whether it's buying back in Sydney or buying in other markets across Brisbane, across Perth, or any other areas across Melbourne right now. Having the ability to say, great owner-occupier area, predominantly owner-occupiers live in that street or in that general suburb, catchments to school, rail corridor, zoning upside, a property that doesn't need money spent on it, which is a big key in this current expensive material and labour cost environment. So move-in ready. Plus the second part is, and probably the most important part, is buying really well. Comparative to the last 3 years, I've probably bought at a price that this property would have been trading for the best part of 2.5, 3 years ago, which, to be fair, is still hard to achieve even in a market that's soft. So that's an example at $1.6 million, but there's examples that in that same scenario in the west and southwest suburbs of Sydney, as well as in the west and also northern suburbs and southwest suburbs of Melbourne, that you're buying those same assets for $550, $650, which have that upside, which have about a 3 or 4%, potentially in some cases closer to 5% rental yields in those same markets right now. And they're existing, which only 12 months ago, you're talking those same properties were trading the best part of 15, 20% higher in value, but also about in the vicinity of about 20% less in rent. So your actual arbitrage, although yes, the actual interest rates have gone up, you're still far better off from a cash flow perspective. Even adding on another 2.5% to your interest rates, you're better off where rents are trending far, far higher. So we expect that demand is going to continue to be quite strong in those areas over the next couple of years as we go through this Albanese government increase of really this skilled migration that's happening right now.
Yeah. So where was this new asset you purchased? Which area?
I was in Miranda. In Miranda.
Yeah.
I was reading a report. Three suburbs from the beach.
Miranda Fair, great Westfield there, isn't there?
One of the greatest, mate. One of the OGs.
18 different chai tea shops there, and they're everywhere.
It was that and Bondi Junction, I believe, that went through those huge overhauls about 7 or 8 years ago when the big money went through just before the sell-off of Westfield. But Frank Lowe and co have made quite a tidy exit out of that, but still quite a good legacy there.
Well, I heard Sutherland, the suburb, which was really an ugly duckling of sort of southern Sydney, is really sort of come up. It's the gentrification through there, and I guess it's a carry on from proximity and closeness to Cronulla and Miranda and all that sort of stuff. But this is how these suburbs work out. We've got another quick break. Stay with us. I want to sort of have a look at where people should be considering Sydney and Melbourne moving forward. Back in a moment.
Have you considered adding Perth property to your portfolio? Momentum Wealth has experts on the ground to help you find the best opportunities in WA. They'll take care of everything from shortlisting and inspecting properties right through to negotiating the best deal on your behalf. And when it comes to managing your property, they have experts for that too. Contact their award-winning team today at momentumwealth.com.au and get your advantage in Perth's property market.
Welcome back, Phil Tarrant, host of Smart Property Investment Show with Paul Glossop. Now, Paul, we spoke about southern Miranda, so I guess southern Sydney, you'd call it, a gateway to the south, the National Park, and down that way. Any other areas of Sydney you like at the moment for, under the concept of it's time to get back into Sydney and Melbourne?
Yeah, mate, I think truly now we're probably starting to see, although the lower price markets of the southwest and the west probably didn't see the same heady heights of growth, nor did they see the same drop-off in value, the actual rental increases are now starting to show a lot more confidence in where those markets are trending. And if I sort of give a few examples, let's say Campbelltown as an example, is one of those anchor suburbs to the southwest of Sydney these days. It's only going to be 15 minutes from the Badgerys Creek Aerotropolis. You've got Western Sydney University, which has gone through a massive campus expansion. You've got direct train links straight to the city. You've got access to the Wollongong beaches, etc. One of those very robust southern markets or southwest Sydney markets now. You're talking you can get cladded homes on 600 square metres in that market right now for probably in the vicinity of $650 if you keep your ear to the ground quite well. But those same properties are renting for north of $5, in some cases $550, $580 a week. So you get much, much closer to that 4.5% rental yields for those types of buy and hold assets, which have still got a really, really strong 10-year trajectory ahead of them. So if you sort of say what's happening in those areas for the next decade to give it a bit more confidence, well, you've still got the best part of $100 billion in infrastructure being spent in those general markets. Penrith and that whole catchment is no different. The Liverpool, Parramatta market's still no different. You do obviously end up creeping up a bit higher in price, a bit lower in yields, but there's areas out there that are certainly more affordable than some of those more premium, whether it's southern Sydney or northern beaches markets that are still there. I think areas a bit further up as far as the Central Coast and the Illawarra, I think they've probably got a little bit further to slide before they find that same bottom that Sydney will, which is typically the way it works.
Yeah, and what are you seeing down in Melbourne?
Well, mate, I think the areas that did really well through the pandemic and that I think will continue to do quite well is if you go further around the Bay, probably more so, and probably not necessarily considered Melbourne, but the general Geelong catchments, as well as over towards the general Frankston catchments, you've got more of those areas which we spoke about that COVID clarity piece a bit more now, where people are sort of wanting to get a little bit more of that combination of lifestyle as well as an area which they're able to afford to get into and gives them that access to their working corridors, hospitals, tertiary education, etc. So if I was looking at which markets I expect will do quite well there over the next 3 to 5 years, I believe it'll probably be disproportionate to those coastal markets that are still in earshot, be it the general Geelong areas. There's still some affordable corridors there. Rents are still quite soft, but I think that area has done really well, but won't see an amazingly strong drop-off in demand because of, I guess, where and what people are wanting out of a general suburb now. And further towards Frankston, sort of you got Seaford, Chelsea, etc., Mount Eliza, but you've also got sort of further down that access down towards Portsea and some of those much, much more premium blue chip markets. Of course, the ocean there. They're still only an hour and a half to the Melbourne CBD or even closer. But you've still got train links, you've got highway corridors, and you've still got a very, very good quality of life in those areas. So for me, they're the areas which I think are going to stay quite strong and consistent over the next 2, 3, 4, 5 years.
Well, there you got it. Maybe it's time to look at Sydney and Melbourne as part of your property investing journey. I'm doing it myself and happy to sort of fill everyone in once I've done that. Thanks, Paul, for those examples that you've given us as well. It's Paul Glossop, CEO of Pure Property Investment. Look out for his book as well. I've read it. It's not bad. Look forward to the second installment of it, Paul.
No, mate, I'm looking forward to writing it or continuing to write it. And,
we'll break it down. We'll pull it apart again when you've done it. And the good thing is that you've been around property for a number of decades yet, so you can just maybe you shouldn't be talking about exit yet. Maybe it's about let it stew. So anyway, thanks for joining us today, mate. Do appreciate it.
No, thanks for having me again, buddy.
Nice one. That's Paul Glossop, Pure Property Investing. Go and check these guys out. Just Google them. You'll track them down. Remember, smartpropertyinvestment.com.au, social media, Smart Property HQ is where you'll find us. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Would you like the latest news and insights in HR, leadership and people management? HR Leader has you covered. Subscribe at hrleader.com.au.